At a certain point, it becomes a poison pill. When you need to go and get more money, nobody will ever talk to you. About 5% of the startups that I meet do not meet the basic criteria. I meet them because I'm a nice guy, because I don't like to say no, because I can give them advice, but I tell them immediately after hearing their idea, hey, listen, I'm not the investor you're looking for. It's like going to a dating club and starting to ask people to marry you.
You're listening to the Startup Podcast. This is an educational episode.
Hi, I'm Yaniv Bernstein.
And I'm Amir Shevat.
In today's episode, we're going to talk about the top 7 mistakes that founders make when raising early-stage venture capital. These are mistakes that are not something you can easily recover from. They are things that can haunt your startup for years, so don't make them. Today, friend of the pod and special guest Amir Shevat is joining us to talk through those mistakes and give you all the tips you need to know to make sure that you avoid them. Can't wait to get into it right after the break. Today's episode of the Startup Podcast is brought to you by .tech domains. One thing about starting your startup that should be easy but isn't is naming it. Why is it so hard? Because all the good .com domain names are taken. So you end up doing something silly like misspelling it or adding random prefixes or suffixes. No more. Your domain shows your focus and intent, so you should make it sharp, clean, and unmistakably tech with a .tech domain. Head to get.tech/TSP or a registrar like GoDaddy to grab your .tech domain today. That's www.get.tech/TSP for the Startup Podcast. Okay, so for regular listeners of the podcast, Amir Shevat needs no introduction. He is a very regular guest with us, but I'll just quickly talk through a little bit about what he's done and why he's so well positioned to talk about this topic. So Amir is a general partner at Dark Mode Ventures, which is an early stage investor based out of Texas. But his background is incredible. He has been an executive focused on developer platforms and relations at companies including Google, Slack, Twitch, and Twitter, where he was famously fired by Elon Musk, which of course is a badge of honor. These are the best developer-facing companies that have existed over the past couple of decades. Amir has had a front row seats to all of them, and he's bringing all of that wonderful operator knowledge into the investor ecosystem. Amir has also published 2 books by O'Reilly Media on the subjects of designing bots and web APIs. So he's just a fantastic all-rounder and a really great speaker and thinker on the topics of startups and VC. Amir, it is wonderful to have you on the show. Let's bust right in.
Awesome. So I wanted to talk about in this session about a presentation that I've given at monday.com. They have a community called Startup for Startups. And I presented about the 7 problems that I see when companies try to fundraise. I'm talking specifically about early stage founders trying to get their first raise. And I've done about 65 investments so far, some of them as an angel investor, some of them as a VC. I found 7 major mistakes that I see when doing fundraising. And I hope that this session will be useful for entrepreneurs to learn from other people's mistakes. Does that make sense?
It does. I'm really excited.
So the first mistake that I see is fundraising at all. About 15% of the startups that I see do not need to fundraise. Fundraise from a VC particularly means that you are building your company to be venture-backed. And venture-backed has certain demands from you as a startup that you might not want to have. You might have a successful startup that is actually making money, even revenue, over all your expenses. So you're profitable. And that means that you might not need a startup, that you might not have a startup. A startup is a high risk, high burn, high reward company that has a business risk to prove or a technology risk to prove that needs the money of a venture company like my company to use that money to prove that thesis on the world and to become a very big company. So, for example, Larry and Sergey, when they came in, they said, we're going to organize the world's information, make it publicly accessible. I saw the first presentation that they made. They didn't have any revenue plans. They thought of selling Google to the government. They said that public information should be publicly accessible, so the government is going to pay us. That was the revenue model. And they had a big vision of indexing the entire internet. Which at the time was big and now it's enormous. So that requires venture money, where you don't know how you're not sure how you're going to make money. You're not making money right now, and you need capital to prove either a technology or a business model. A lot of the companies that I see, they want to build a business, or like the 15% that I see, they want to build a business that maybe will make $5 million. That is amazing. That is great. That is not venture backable company. So the way the math investments work in venture capital, you need to have 100 times your money if you invest in early stage companies. Because you're investing in multiple companies, the probability of them failing is very high. So the return on your investment in each of your investment needs to be extremely high. That's why we're always looking for unicorns and decacoins. The probability game means that every ticket that you buy needs to be a lottery ticket, and not just a ticket that returns 1.5 on your money.
So, it's funny. People often refer to startups as being rocket ships, as with this very positive connotation. It's like, if you're offered a seat on a rocket ship, don't ask which seat, just get on. We're going to the moon and all of that. But I actually think that the metaphor is deeper and more interesting than that, and remains accurate, right? So rocket ships are uncomfortable. They blow up a lot. And also, their aim is to get into space, right? Like a rocket ship that reaches 10 kilometers into the sky, that's failed, right? That's just a plane without wings, right? A rocket ship needs to go a really long way. It's really risky. It's uncomfortable, and it requires a lot of resources. I think in this analogy, Amir, what VC is the rocket fuel, right?
Exactly.
So you have a rocket ship, you're trying to get into space, you need rocket fuel. Now, if what you've got is not a rocket ship, you've got a light aircraft or a car or a bus, you don't put rocket fuel in that thing. You're looking to the wrong place for your fuel. So, I think it's funny. People, it's quite popular on LinkedIn to rag on VCs. It's like, I raised VC money and now they're stopping me from just, having a profitable business, and they keep pushing me to grow and grow and grow. And often that results in failure, and that's not fair. And it's like, one of the things we say a lot on this podcast is know the game that you're playing. And I think it's great to hear from a VC, right? It's like, VCs are in the rocket fuel business. So they're expecting you to build a rocket. If they give you rocket fuel and they find that you've put it in your Toyota, they're not going to be happy.
I love the rocket fuel metaphor because it also shows you how many planes you have versus how many rockets you have. You have hundreds of planes making money, being commercial, good businesses. Same thing. You could build a great business without VC money if you're building an airplane, if you're doing something that is not going into space, that doesn't have any wings. There's a lot of companies that are making good money and do not need rocket fuel at all. So make sure that if you really, really want the rocket fuel, make sure that you're building a spaceship.
That's right. And look, there's only one reason to be building a rocket, and that's if you want to go to space. So I think as a founder, you need to be really honest with yourself, right, Amir? It's like, ask yourself, do I want to go to space? Do I want to build a rocket? Be honest with yourself about your motivations. And I think we do have this sort of complex of putting these rocket ships on a pedestal, right? Talking about unicorns and decacorns, and then celebrating fundraisers, maybe a little bit less than back in 2021, but nonetheless, this is seen as the way to do things. And I think it is a way to do things, and perhaps the most ambitious founders, the ones who want to get to space, this is what they should be doing. But you start with looking inside yourself and saying, do I want to go to space? And am I willing to do what it takes to get there? If not, don't build a rocket.
I pinpoint a few questions that you need to ask yourself. So sometimes you hear from VCs, I'm not sure about the TAM. TAM is a total addressable market. How big is the market? One of the aspects of space, of like building a rocket ship here, is, am I building something big enough? When I was at Google and you pitched an idea, it had to touch $100 million or 100 million people. That was the litmus test for a big idea. So I think that's a good analogy for you if you're thinking about whether you're building a big business. Are you touching 100 million users or more? Or are you planning to get $100 million or more in revenue every year? If you're doing that, that's a good indicator for a big TAM. The second question that I have is are you willing to put 7 years into this? The startup takes time, a lot of time. On average, 7 years from the ideation until you exit, either through acquisition or IPO. It could take even 15 years. Good companies take a lot of time to build. So are you ready to put in the time? Or maybe it's a company that you want to build build for 2, 3 years, and then sell. That is okay. That is not a VC business. The last question that you need to ask yourself is like, do I really need the money? Can I fund it myself? There's a lot of opportunity to do bootstrap today. We were just talking about vibe coding. It could be that now vibe coding is for prototyping, but it could be in the future that you'd be able to build major software with it. I don't know if you need VC. For many ideas, you might not need a VC backing.
Yeah, we actually did an episode not that long ago, Amir, about the funding continuum, right? Because I think, you can bootstrap and you can raise VC, and those are kind of two ends of a spectrum, but there's a whole bunch of stuff in between, right? You can do a small angel round, you can do revenue-based financing or other sorts of debt financing. Angels are interesting because in a sense that they're an equity funding model, but they don't necessarily need the 100x, right? And so all of these things, it's like, know the tools that are at your disposal and use the correct one. And, I think it's really refreshing to hear a venture capitalist say this, but of course it's in everyone's interest, right? A good VC does not want to fund founders who do not know that they're trying to build this unicorn. Maybe you need money. I think often, that is the question. This is sort of the thing that happens with founders, is that they need money to run their business, right? Sure, you can pure bootstrap. In that episode I refer to, I mentioned that pure bootstrapping is pretty rare, right? Quite often what you're actually doing is self-funding, which in my view isn't pure bootstrapping. You're taking outside money. It just happens to be your own, right? You are your own angel investor, which is actually the riskiest thing to do. But yes, you go all the way from pure bootstrapping, right? So most people need money to run their business. And so they're like, I need money, I'll raise VC. It's like, no, I need money. I have a whole menu of options for how I get money to run my business. And let me choose the right option for what I'm trying to build. So again, to my earlier point, I think the first thing as a founder you need to do is look inside yourself and say, what am I trying to build? And then what is the right sort of outside support, if any, that I should get in order to build that thing?
So mistake from number 2 is fundraising from the wrong people. There's 2 levels, 2 categories of mistakes: going to the wrong VCs and literally raising from the wrong people. Raising from the wrong people is very early on, you might go to people who fancy themselves as angel investors, but are actually not angel investors. They won a lot of money in the crypto, or they're in real estate, or they make a lot of money from somewhere else. And now they want to venture into becoming an angel. And you're one of the poor souls that need to educate them on how to give money to a startup. They're not used to giving money and forgetting about it. When I look at an investment and I make an investment, I know that there's a high likelihood that I will never see the money. I know that there's a high likelihood, very high likelihood, that I will not see any return in the first 5 to 7 years. If you're taking money from someone who's not a professional investor, they will make your life miserable because they don't understand these points. They will want to get their return. They will say, hey, I need some money. Can you give me my money back? Or they will say, hey, you're raising more money. Give me some of my money back. They will come up with different ideas of how you owe them money now. And that's a very, very bad position to be, to raise from a non-professional investor. When I was an angel investor, I always used to say, hey, go and meet one of my previous people that I invested in and get references. I think this is super important, especially when you're dealing with an investor that you don't know for many years. Go and get references on someone who's not a professional VC. And even if a professional VC invests in you, go and get references from different founders.
Yes, we call it dumb money. You're being politer, right? But yes, not all money is equal. And again, coming back to know the game you're playing. If you as a founder know the game you're playing, you need your investors to know the game that they're playing. And it is in that angel investment space where you're most likely to find people with money trying to play the game, but not understanding the rules. And, like you said, they could ask for their money back, but even a level lower than that is you can just get, as a founder, a lot of anxiety and stress sprayed in your direction because they're like, why aren't you making revenue yet? You'll get unsolicited advice. They'll get frustrated that you're not listening to them. They're asking you about exits. Yeah, all sorts of stuff. Because what they don't realize is that they've sent their money on a long and perilous journey, right? And it will either come back full of treasure or more likely it will never come back at all.
Yeah.
That's what you signed up for.
The second lesser problem in this category is going to an investor who's not investing in your field. The risk here is just being frustrated by a lot of no's. About 5% of the startups that I meet do not meet the basic criteria. I meet them because I'm a nice guy, because I don't like to say no, because I can give them advice, but I tell them immediately after hearing their idea, hey, listen, I'm not the investor you're looking for. An example would be I invest just in what's called B2B, business to business. I invest in enterprise software. I invest in developer software. I do not invest in B2C apps. So if you're here to sell me on the next Instagram, that's probably the wrong bet. So make sure that the investor that you meet has made investments in your area. They will not be useful, and you'll get a no if you're reaching out to investors that are not in your domain.
Like you said, it's less of a problem because all you're doing is wasting your time instead of signing your own death warrant. But yes, you need to think about, how do I actually find people who invest in what I do?
Okay, so next mistake number 3 is cap table chaos. A cap table is a table that every startup has, which is basically a table that defines who owns what. When you start as a single founder, that cap table has your name and 100%. If you have a co-founder, it's hopefully 50-50. And then as you introduce more investor, more advisors, more employees, each of them gets a piece of the action, gets a piece of the company. And your cap table becomes bigger and bigger. There's a few problems with cap tables, a few red flags. One of them is called a party round. A party round is when you bring a lot of people to put very small checks. That's usually in the stage that's called friend, family, and fool, the 3 Fs. When you're trying to raise your first money and a lot of your friends are saying, hey, yes, I'll join and I'll put $5,000. And then you get 100 people in your cap table that have put a very small amount. That is a problem because you have duties to each of the person in your cap table. You need to provide tax documentation for each person in your cap table. Each person in the cap table has rights. For example, when I sold my company to Twitter, Twitter mandated that every person in the cap table will sign the document of the acquisition, because it had clauses that said that we will not sue them, that they take all the IP and all the people, and there's no legal dispute. And I had to go through, I had 28 people in my cap table, and I had to go to each and every person and have a Zoom meeting and make sure that they signed that document. Believe me, if you have a lot of people, that is a pain in the butt.
Yeah, actually, I've just gone through this as an investor. I've invested in this company that is going through a merger at the moment, and it is a fantastic deal. It's a really good merger, really great deal for the company. And there was one holdout investor that, for reasons that none of the rest of us could fathom, wouldn't sign the papers, didn't like the deal. And the founder was going insane because they didn't realize that a single investor with a pretty small shareholding could hold up the whole thing. And it's actually delayed things by 3 months so that we could actually get this person off the cap table. So yes, every one of them has rights. And that also goes to the previous mistake, Amir, which is this person was not a good angel investor, right? And so when something obviously sensible was happening, they held it up because they didn't understand why this was just a no-brainer merger. I do have a question for you, though, in this context, which is, what do you think about RUVs in the context of party rounds? Does that mitigate the issue?
Yes, I think so. RUVs and SPVs are vehicles. They're basically tools to gather people together to invest in a single line item. I love those. If you bring all your friends and you open up AngelList is a good tool to do that. You open up AngelList syndicate and you get everybody to invest in that vehicle. It's a great tool because it gives multiple people to invest in a company where the line item for the company is a one line item. So you invest in the investment vehicle, and the investment vehicle invests in the company. I think that's a great solution to solve for that problem. So more problems in the cap table. Not enough equity for the founders. And I get this a lot, where the founders made a mistake of putting too much, giving too much of their equity to the first investors, if you don't have more than 60% of your company when you come to me for early stage investment, I will not invest. And this is not because I'm a hero, I'm Robin Hood of VCs. It's because it's a broken cap table. If I invest and we take more equity from you and more equity for you, it's going to be very hard for you to raise later on. If you don't have control over your company and you don't have enough equity to merit you not leaving and going to Google or to Facebook to make a good salary and not get a pain in the butt from doing a startup, you need to have enough equity for it to be life-changing for you as a founder. And if not, then it's a broken cap table.
Just on that, I think one of the mistakes that both investors and founders can make is they think of the cap table as a pie, right? You're slicing up the pieces of the pie, and if I get more pie, that's great because I like pie. But actually, it's something closer to, I don't know, Amir, like an ecosystem, right? Like there needs to be balance on the cap table. All of these different interests need to be represented. And so this is not this zero-sum game of like maximizing the amount that I get at your expense, whatever parties we are. We need to have this sort of healthy ecosystem. And this is one of the things that it took me a long time to learn, right? So when we say a broken cap table, what do we really mean? What we mean is this is an unhealthy ecosystem on the cap table, and that unhealthy ecosystem will lead to the failure of the startup if it is not addressed as a matter of urgency.
100%. And I'll give the last example, and then I'll talk about solutions to solve this. The last example is what's called dead equity. So let's say we had 3 founders, and we decided that the third founder is not good. And we had 30, 30, 30. And now there's a person who's not in the company, who's not useful for the company, who has a lot of equity in the company, who has left the company. So you have to, as a founder, you have to manage that aspect and make sure there's ways to solve it. You can say, hey, we're going to pay for you're going to buy you out, or we're going to give you a much smaller piece of equity and give you a advisory position. There's multiple ways of solving it, but if you have more than 10% of what's called dead equity, that's a symbol that your cap table is slightly broken. Now, let's talk about the ways to solve it. It's fun, like, a bullet in your leg kind of experience, but it's called recapping, or sometimes called a down round in some places. Recapping is taking the cap table and playing with the numbers, changing the position that every person has in order for the cap table to make sense. And because the cap table is basically imaginary and agreed by humans, you can change the numbers. So let's say you invested in my company and I gave you 60% of the company for $100,000. I made a big mistake because I was a young entrepreneur, and now I have 40%, you have 60%.
And no one will invest.
I'm unfundable at all. And now I come to you and I say, hey, dear investor, we have 2 options. One of them is that the company closes and then you lose your money, right? You put in $100,000, but you have $1,000 of nothing because I've left and the company is broke. If you want for me to raise more money, if you want to actually have a chance in getting a piece of a good cake here, you need to change your equity stake. You need to have less of the company. So let's say we'll change your equity stake to be 15% instead of 60%. Will you be happy?
No.
Probably not. But the alternative will make you less happy, which is to lose all the $100,000. So recapping is a process where you need to go to each of your investors and each of your employees, everyone in the cap table, and say, hey, you had X amount, now you have X minus amount of equity in the company. And that is painful because people don't like to lose, and investors don't like to lose at all. But I've seen that, and it's a painful but doable process. And if you do it well, and if you do it early enough, you could fix. And one of my companies had to do a recapping. Basically, we lost about 60% of our holding. But now the company is on an amazing trajectory because they got new money and they have a lot more cash and good direction for their company. So for me as an investor, I have much less of a bigger company. So I'm very happy about that.
That's right. And so, yeah, I think that the hard thing here is that really human aspect, right? That feeling that you are having something taken away from you. that view of this thing as a pie and you having to give that pie back, rather than, hey, the ecosystem is unhealthy and we need to rebalance it. So yeah, and as we were saying before, a recap can only go ahead with the consent of all shareholders, right? So it requires a lot of good faith negotiation and probably a lot of emotions, unless you have complete pros on every side of, every line of the cap table. You're going to have some difficult conversations.
And I heard about founders who had like extremely bad conversations with investors that were just saying, no, you can't convince me. And that's extremely painful because it's your baby. You invested so many of your time and money in making this happen. And somebody could just, for no good reason, say no.
Well, I mean, again, I think it's a misunderstanding because the founder's coming to the investor and is basically saying, give me some of your equity. And the investor, if they don't have confidence that the founder's acting in good faith, it can just seem like a grab. And so I think people get defensive and reactive to that, right?
Exactly.
In terms of remedies, like, is this also what you would advise with debt equity from departed founders? Or how would you approach that?
So with departed founders, I think it's a matter of hopefully getting into agreement that helps both parties. If you and I were to do a startup and we would get 50% and 50%, if I were to leave, I would to say, hey, listen, I'm going to give back 90% of my equity. So I stay with 5% and I give you all the equity back. And if the company is sold for $1 billion, I'll know you'll take care of me. So I'll make a gentleman's agreement. If you can reach that, that is amazing. If you cannot, then you could use recapping or dilution, like making sure that there's more and more equity in the company so that the company's previous owners have less of the pie. There are certain ways to what's called dilute that equity if you cannot reach amicable agreements.
What do you think of founder vesting as a way of avoiding this situation in the first place?
Founder vesting is awesome. I think founder vesting is very useful, especially when there's multiple founders. So there's two tools. There's founder vesting, which means I have half of the company, but I actually don't have half of the company. I only have the prorated portion of that half across 4 years. So in the first year, I'll get 25, and then the next year I get 25. It's a good system. There's another system that's called the cliff, which means if things don't work well in the first year, I get nothing. So a combination of a cliff and vesting, I think, is a good tool. But it all depends on how much trust you have between the partners, how much history of solving difficult and having difficult conversations. I think that like if you and I were to start a startup, we wouldn't need the reverse vesting. We would have the understanding of what happens if one of us want to leave. But if you meet someone who's like you've been dating founders and you found a founder that you don't have that long-term relationship with them, you might want to do things like reverse vesting and cliffs.
It's funny you should say that because personally, I'm an advocate of always doing it, right? It's like, yes, there's a lot of trust between us, but it's like a prenup, right? It's downside protection. And it's saying, hey, if you leave, instead of having the gentleman's agreement that we'll do a recap, the recap's written into the contract, right? That's really what founder vesting is, because usually the mechanism is a clawback, right? So you're saying, hey, if you leave after 2 years, you give up half your shares. And that just seems like a sensible way. It's like we've pre-agreed it. We don't have to have that conversation later on in case things do go wrong.
100%. I don't have a prenup. It's probably good to have a prenup. I work on a lot of trust. But it worked for me and my wife. We've been married for 25 years. No need for a cliff there. But I agree with you. For most cases, having more clarity with documentation and an agreement is probably the best way forward.
All the best .coms are taken or crazily overpriced, so you settle on a workaround domain for your website. Don't compromise. Get a clean, sharp .tech domain that instantly says, this is a tech startup. Grab yours at get.tech/TSP for the Startup Podcast or via domain registrars like GoDaddy.
Okay, now let's talk about problems when you actually find an investor and now you're negotiating the round size and the valuation. Okay, so let's say I met an investor, they love what I do, they really like the deal, and now we're talking about how much money do I need and what's the valuation that I'm seeking. So the first mistake is raising too little. Very common in early stage founders. they think that raising 100K is less complex than raising 1.5 million. One, from my experience, that's not true. It's the same amount of pain. Second, if you raise too little, the problem is that you continuously focus on raising more. You're continuously in a stage of starvation. And I've seen this, I call this the salami pain, because they cut you like a salami. So like you raise 100K and after 3 months you run out those 100K and you run to get more 100K more. And every time you give another piece of your company and you sign another document and you run after another investor. And the problem is that your focus, the major problem is that your focus is not on your customers and on your product and on your technology, but rather on the investors all the time. And that's a fundamental problem. If you're raising too little, you're always in a stage of starvation. So that's one problem.
That is a general observation, right? That there is nobody who is as obsessed with money as somebody who doesn't have enough of it. And, actually there's a switch that happens in the human brain, right? Which is this sort of starvation mode where you're like, okay, scarcity, I need to focus on it. So ironically, the best way to not be thinking about money the whole time is to have enough in the bank so you can focus on building your product.
The second edge of that sword is raising too much. That's actually a minor problem, but you need to be aware of that problem. The problem is that if I manage to raise $100 million, I might not be able to manage the burn rate really well. Because once you have too much money, you start investing in things that might not be useful in the early stage of their company. So if you're a seasoned seasoned entrepreneur that knows how to take $100 million and make an amazing company out of it, that's great. But if you're a very early stage entrepreneur and you manage to get too much money, the problem is that you might run into burning too much of your company's money. And then when you end that runway, you might not have made a lot of progress. So raising too much could be a problem if it impacts your burn rate in a negative way.
Yeah, that's right. So in a sense, there's no such thing as too much money. But as you say, the temptation when you have a lot of money is to spend it and maybe not to spend it wisely. The bigger problem with raising too much money, which I think you're coming to, Amir, is that it tends to come with a too high valuation as well. And that is a much bigger problem.
Okay, so let's talk about the valuation on both sides.
Yeah.
Too little evaluation, if you say, hey, I'm raising $1 million at a $2 million valuation, I've given half of my company. So too little valuation is very bad because, again, coming back to the cap table and recapping, I've given too much of my company. Too high valuation is also a problem because basically evaluation is a promise to the value of the company. Let's say I've raised $1 million for $100 million. That for me is a catastrophe raise. Although on paper it looks amazing. I have $1 million in the bank and I've only given 1% of my company. Why is that a horrible raise? Because basically now I have a company that's worth $100 million with just $1 million of burn rate to prove the next round. And for the next round, I need to prove that I am worth $150 million or $200 million. And doing that with a very small amount is very risky. So being very greedy on the equity and getting a very high valuation and not enough money is a pitfall that is very dangerous. The way to solve this is the golden rule of 15 to 25. Make sure that you have enough money for your next round and then give equity. Calculate your valuation based on a target holding of 15% to 25%. So if you're raising $4 million, make sure that your company is between 12 and I think 18, if I do the math right, $1 million valuation for you to give away between 15 and 25% of your company.
The thing I always say, and the framework that I use, is you've got these three things: the round size, the valuation, and the amount of dilution. But there are only 2 degrees of freedom. In other words, once you choose 2 of those things, the other one just falls out in the maths. And what you are saying, Amir, is choose your round size. How much money do I need? Generously, but not too much. The Goldilocks amount of money I need to get safely to my next round. And how much dilution do I want? Between 15 to 25%. and the valuation just falls out, right? And I think that's actually once you think that way, it really kind of inverts things, right? Because if what comes out is a very high valuation, then maybe what you should be thinking is, this isn't a very good business, right? To be able to do this thing, I need to be able to justify that this is going to be $100 million, $150 million business by the next round, and I don't think I can do that.
Exactly.
And if it's a low valuation, then, well, okay, that means you've got a very efficient business.
Or you made a mistake with your calculation. Maybe you need more money.
Maybe. So going very back all the way to the first point, maybe you don't need to raise VC. But if you do raise VC, well, then, maybe you can raise a decent amount of money. This is the luxury problem, right? If the valuation comes out too low, it's a luxury problem. You can raise more money than you need if you believe that you, as a founder, have the self-discipline not to overspend if you have that money in the bank, right? You can raise that round size, but don't think that you should be spending it faster, right? Stick to your optimal burn plan, not what you have in the bank.
And really try not to give away more than 25% of your company in each
Because
round.
then you have a broken cap table.
Exactly, and that's predatory. Like it's like a dating red flag. If your investor asks for more than 25%, that's a red flag. That's a predatory investor. Next problem, time wasting. And the problem is that VCs and founders see time in a different way. When I'm a founder, I want to make the fundraise as fast as possible. I want to spend as little time talking to investors and the most amount of time talking to customers and focusing on my product. The problem is that it's the opposite for investors. Investors, if I spend more time with you, I get more signal whether this is a good deal or not. The more time I wait, I get more clues whether you're able to grow your business, build your product. As an investor, time is advantage, and as a founder, time is a disadvantage. Yes. You need to understand that when you're building a relationship with your VCs, because a lot of VCs will, it's called wasting your time, but it's a little derogatory than it is. They want to spend more time with you to build more time for conviction. The problem is that if you do that over a lot of time, you basically, your job as a founder is investor relations rather than building a good product. And you need to focus on a good product. So the best practice here is to manage the scope of time you're willing to spend on investment and time box each process. You need to build your pitch, really focus on practicing it with 100 friends or 10 to 100 friends, and then finding the VCs that you want and time boxing the meetings with them up to 2 months and meeting with them on a very, very intense basis until you close the deal. If you do it over 6 months, you're basically, and I have seen fundraise that took 6 months, you're basically stealing money from your business and stealing focus from your business because you could have spent all that time talking to customers and not to investors.
Look, I agree with that. And, there's another angle, I guess maybe bringing more of the founder angle to this as well, Amir, is, first of all, you're a nice guy. You've got a great VC fund, but not everyone is as scrupulous. So there's another reason, as well as getting to know the company, that VCs might slow play you, which is that they gain leverage as you run out of money, right? Exactly. So if you let them just spend months and months back and forth, never close, your runway is getting shorter and shorter. And like I said, if the VC is just a bit more cutthroat, they will know that, and they will use that to squeeze you for various concessions. And so you need to get this thing done. And, related to that, all of this is, you're talking about wasting time. I think it's also about timing, which is, I think, as a founder, understand that VCs, even the good ones, have this incentive to move more slowly than you do. Do not wait until you're nearly out of money to start a process, right? Do it when you've got 6+ months runway and then run a tight process, right? Because then you're like, okay, you know what? Like, we want to move fast. We're going to put a time box around this, but also we're never going to act desperate because we're not desperate. And that's really important in any negotiation.
I love that. That's so smart, because if you don't give yourself 3 to 6 months, it's like going to a dating club and starting to ask people to marry you. It doesn't work that way. You need to date. You need to have a little bit of like drinking, maybe get to know each other before you go into a marriage. So give it yourself 3 to 6 months. Another thing is to communicate the timeline. I really appreciate when when startups ask me at the end of the pitch, how long does it take you to make your mind? And I usually tell them, listen, I meet my my partners every week, and I can slot you into this week investment committee, and I can give you an answer by next Friday if we're moving on. And usually we can get the entire process done within 10 days. Okay, so I'm very, very clear with my process, and a lot of VCs are okay with that. Like they're okay to disclose the amount of time. I think communicating time and urgency is very important here. It could be that the time doesn't work, and that's okay. And as a founder, you need to have enough grace to say, hey, listen, if this timeline, I need to close this deal by the end of the month. If this timeline does not work for you, that's totally okay, and I'll see you in the next round. This is remember, 7 years. This is a long run, and you need to build relationships. So it's okay for the timing not to work this time and the timing to work next time. Okay, so you agreed on the terms and everything okay, and your cap table is great, and then your investor asks for a side letter, or they bring their own investments document. All red flags. There's very few side letters that are okay, and a lot of side letters that are not okay. Why is this a problem? Because basically every legal document that you sign, you basically mortgage your future. Because me as an investor, when I look at a company, I want to try to see that there's no legal things that are binding them negatively. Examples of good or okay legal documents are pro rata. Pro rata is an example of I'm an investor, I invest money in your company, I get 5%, and I keep the right to continue to invest in your company to continue to hold 5%. That sounds like that's a standard, sometimes it's negotiable, that's a standard legal document. A non-standard legal document is if, let's say, Samsung invests in you, and they tell you in the legal document that you cannot share this information with Apple. I've seen similar things happen. And the problem is now you've gotten money, but you've gotten that money with a poison pill. You basically signed a legal document that limits your business. The same goes with some countries have government investments that comes with legal repercussions to it. Sometimes there's information rights, meaning that the company that invests in you, and that's very much tied into corporate VC. So corporates that invest in you, let's say IBM invests in you, and they want information rights on your customers. That is very risky. Again, I really like standard documents. There's a document called SAFE, which Y Combinator created. Use that. If you're doing a price round, tell your legal team to generate the most standard, basic investment document. Don't sign any side letter that might risk your future. The ones that I usually ask for, but I'm okay with not getting, is pro rata, because I like to continue to invest in companies that I invest in, and I like to continue to invest time and money. That is an okay side letter, but other than that, I would be very wary of any side letter or non-standard legal documents.
So there's one other kind of side letter that I've asked for, Amir, in safe rounds, which is a most favored nation side letter, which basically means, okay, if I'm paying an $8 million cap, you can't, and then you raise money from someone else at a lower cap, then I get that lower one as well. And that seems reasonable because it's just basically saying, I don't want to get a worse deal than someone who comes after me.
That's a perfectly reasonable side letter. And that's how business is usually done. Definitely agree that that's a reasonable side letter, but information rights or IP clauses or any dividends or any liquidation preferences, you should really, really consider not doing those, especially in the early stage. You could do that in later stage. Don't do it in an early stage.
I think it's good to sort of be clear about the why of that. Like you said, you're mortgaging your future. And the way I sort of view it is in terms of incentive misalignment, right? Because suddenly these investors are asking for things for themselves that bind your future actions in a way that may not be in the best overall interest of the company. So you're caught in this web of conflicting incentives, especially if different investors have different special terms, such that, you can get to a point where you're like, I can't do the right thing because I'm bound up in this web of contracts.
It's a nightmare because like startup life is hard enough. When I was a founder, it felt like I was on a roller coaster all the time. Adding more legal problems into that roller coaster is definitely not fun.
We were also talking about the timing thing before. One of the issues is founders feel a lack of confidence, that they're worried that they don't have the leverage to say no. They're afraid of saying no to investors because they're like, I need the money. And if they ask me for this thing, then I need to give it to them. I think this feeling is really problematic, right? Because the only point of doing this thing, okay, we're building a rocket ship, guys. If you are taking on some rocket fuel, but they're like, well, you have to strap these lead weights to the side of your rocket, you're never going to reach space anyway. All you're doing is wasting your time in a long, protracted, painful way. If you cannot raise in a way that doesn't handicap your future, then you're not able to raise. Like, don't pretend otherwise. All you're doing is causing yourself a huge amount of heartache if you're willing to take these sorts of terms.
100%. And the way to think about it is alternative cost. So if you say yes to a bad term, you're basically saying it will be much harder for me to do my startup. And startups are, by definition, extremely hard. So why are you doing this? And at a certain point, it becomes a poison pill, which means basically you get more money, but in 3 years or 2 years, when you need to go and get more money, nobody will ever talk to you. And that's even more frustrating because now you spend 2 years of your time because you said yes, and now you cannot raise more money. And I've seen very sad examples of that.
I think the general point, Amir, is you have to be willing to let your startup die, right? In some ways, it's your baby, but it's not a baby, right? It is both legal and moral to let your startup die if the conditions for it to be viable are not there, right? If you cannot raise enough money to manage your dilution, right? If you have to break your cap table to raise enough money, well, then guess what? You don't have a viable startup. Even if someone will give you that money, you don't have a viable startup. So you're better off shutting the thing down than taking the money on those terms. And, it's maybe a harsh thing to say, but, that's the reality. And ultimately, you only have one life. That allows you to move on to the next thing. Otherwise, like you said, all you're doing is you've trapped yourself in this vessel that is eventually going to blow up. But in the meantime, you're pouring your heart and soul into it.
And I was in IC meetings, in investment committee meetings, where we talked about the founder and we said, this is an amazing founder, but he signed a very bad legal agreement. And the question back to me was, is this really a good founder? Because if he signed this bad legal agreement, he's actually not a very good founder. It's a reflection on you as a founder to be able to say no to bad deals. And you should do that not as a sign of weakness, but as a sign of strength.
Yeah.
Final mistake. And I'm sure people might say that there's more mistakes, but these are like the major mistakes that I see every day. The last mistake that I see are the relationship mistakes, which is to take things personally and to take no as the end of the game. When I was a founder, I got hundreds of no's. VCs told me that my idea was not good, that my team was not good, that the timing is not right, that the town is not right. I kept in good relationship with each and one of the people that told me no. It is a gift to learn from the no. So I usually try to ask why no and what would make it a yes. But I wouldn't press. And the idea is that this is a game of long-term relationship. VCs might tell you no right now, but they will continue to look at your company. And if your company is successful, they will join the next round. The key here is to maintain good relationship and not burn bridges with anyone. This is business. This is not personal. So if somebody told you, I think this is the wrong team, that's why we're saying no, you tell them, hey, I really appreciate it. And if I'm successful, I'll come back to you and I'll try to raise again because this is the way the game is played. Another thing that I do as a founder was to send an update of the company to all the investors that said yes, but also to the investors that said no. This is important because I just want to keep good relationship with them. And it was a great signal for them that I continue and that I have the grit and that I'm building something that is big. And usually when I do that and I want to raise again, they're very open to have another conversation after the initial no.
Yeah, look, I mostly agree. The only thing I challenge on that, Amir, is if they're an asshole, if they've burned you, if they've acted in bad faith, I'm quite happy to burn that bridge, right? Like, I think this idea of never burning bridges can sometimes allow bad actors to stay in the ecosystem because everyone's too afraid to call them out.
I agree, and I think the way to not burn the bridge that way is like the very Californian have a nice day and fuck you, which is like to say, hey, yeah, that's okay, I got to know, or you acted like an asshole, and I want to work with people who are have more conviction about my company.
That's it. Move on. Yep. Look, I agree. It's a long game, and yeah, you need to be comfortable with rejection in this game, right? And yeah, rejection often is not forever, and you never know. That's the thing. You never know when you're being rejected, whether it is a true rejection or a not now, because the words won't tell you. Not now could mean never, and no could mean not now. Nobody can see the future, and so keeping up those relationships is absolutely a game of networking. I agree with that.
And those investors that told you no, when you're successful, will say, I always believed in you, and will give you their money. And you should be graceful and tell them, yes, I love your positive feedback, and take their money and make a big company, because that's the end of the game. The end of the game is to build a great company. The same thing with people that leave your company. When I left Slack to join Twitch, Stuart Butterfield gave me a hug and told me that his dream is to have a Slack mafia in the entire Silicon Valley, composed of amazing people that left the company to create new and startups and help other companies. And
that's beautiful, hey?
Such an amazing thing. And I will always be grateful and helpful if he needs me.
That's really the Silicon Valley ethos, isn't it? That, you know, this is a cooperative infinite game. This is not a sort of zero-sum one-shot game.
Exactly.
Don't burn bridges.
So that was a list of mistakes. I've seen this repeated many times, and I just want to give a heads up to new founders that are now looking to fundraise.
Yeah, I'm so grateful, Amir, and I think that the new founders will really appreciate this, because it's heartbreaking. Like, to me, when I see people make these mistakes, these are not little tactical errors. These are life-changing mistakes, and they're avoidable. And, you know, founders come from all walks of life. And so this more commercial side of things, how to structure a cap table, understanding the rules of the game, it's not so easy to them. So, you know, this is one of those things where it's not just going to save you a few weeks. This could save you years of pain and heartache if you avoid these mistakes. So thanks so much, Amira. It's a real service to the community that you do this. So yeah, it's been a really great chat, and we appreciate it.
Thank you, Yaniv.
If people want to get more of your great wisdom and insights, Amira, where can they find you on the internet?
They could Google me. I worked at Google, so I'm very Googleable. They could Google me. I'm on Medium, and I'm on LinkedIn, and on Blue Sky as Amir Shevat.
Wonderful. And of course, if you're a founder building a rocket ship and they fit your thesis, I'm sure you would love to have them get in touch with you.
Yeah, and they can come to darkmode.vc. Yeah, I'm Amir at darkmode.vc if they want to reach out.
Fantastic. Thanks again, Amir. Have a good one.
Have a good one. Bye-bye.
Today's episode of the Startup Podcast was brought to you by .tech Domains. Naming your startup should be easy, but it isn't, because all the good .com names are taken or wildly overpriced. No more. You don't have to compromise. Your domain shows your focus and intent, so make it sharp, clean, and unmistakably tech with a .tech domain. How do you do that? Head to www.get.tech/TSP or a registrar like GoDaddy and grab your .tech domain today. Get.tech/TSP for the Startup Podcast, so they know you came from us.